First of all, with the measurement, you need to know what exactly do you mean by brand? What exactly are you measuring? And we characterize it in this way. So if Virgin is a branded enterprise with 400 separate businesses, within that, there are individual businesses like Virgin Atlantic. It's what we call the branded business. And within that, the reason we call it the branded business is because it is a business trading under a particular brand or trademark. And within that business, you can attribute value to the trademark. For me, the trademark valuation piece is normally reserved for technical valuations like tax or balance sheet, where you are obliged to put a number on it at a point in time. The really interesting thing, and the thing for marketers, is the value of the branded business and how you actually drive that value up by making the right actions. And I've described some of the ways you can do those right actions. But as an aside, I was asked, so I will tell you about the ISO. The ISO is very specifically not about valuing a branded business. It is specifically about valuing the brand within that business. Now, inevitably, certainly for us, the way that we would do that is to start by valuing the branded business and then attribute some of the value to it. So this is just a brief technical explanation of how that works, if it's helpful to you. There are 3 pieces of analysis that you have to do. First, a legal analysis to know you own the brand, which may sound silly as well, but quite often companies do not have proper legal rights over their brands. Secondly, you have to do detailed behavioral analysis to understand how strong the brand is, and then finally you put a financial value on it. The standard says you must do it on a segmented basis, and one of the reasons for that is legal rights are on a segmental basis. Trademarks are owned in geographic places for classes of business. So if you want to put a value on it, you have to put a value on the specific rights. But conveniently, that helps marketeers because marketeers do things on a segmented basis too. Right. Secondly, the research. So they expect you to look at market and consumer trends, various different types of stakeholder research, econometric modeling to find causalities, and then predictive research. One of the things it says is be very careful to understand why you are doing the valuation. Because if you're doing a valuation for a technical reason, you probably need less due diligence than if you're using it for a commercial reason. And there are many reasons. Finally, it outlines the ways you can do it. You can look at what it would cost you what could you sell it in the market. Generally speaking, there is no open market for brands, so that's a bit irrelevant. You can look at what it costs you to create it or might cost to recreate it. Hypothetical, not really terribly relevant. The main one is what income does it generate? Now, the way that we do it, and I think the way it should be done, is first you value the expected future stream of revenue from the branded business to put a value on the branded business. So you can see the big blue circle is the discounted net present value of the expected future earning stream from this particular business. And then within it, we attribute a piece, and that's the brand value. Now, they actually say there are 2 ways you can put a value on that piece. You can use indirect methods where you just take the revenue and apportion, say 20% of it, 25%, based on some kind of analysis. And you say 25% of the revenue belongs to the trademark or the brand in that business. That is sometimes known as the interbrand approach. Sometimes people say that that is slightly a black box because they don't know how the percentage is derived. So the method that most financial people prefer are what's called direct methods on the left here. And they outline a number of direct methods that you can use. It is not prescriptive. It gives you alternatives. So what they're saying is you, as a valuer, are trying to identify the specific value of that trademark in the context of the business. For example, you could look at price premium, but obviously that doesn't take into account volume effects. You can look at cost savings, but most brands are not really about cost savings. They're about revenue. And the 2 that are left are the margin or earnings uplift effect, where you look at the whole business model and say, well, what difference does the brand make to it? But the simplest method, the one that accountants tend to use for balance sheets, is called royalty relief, where you just imagine someone's going to license me this brand, what will I pay them for it? So you have to work out what you would pay that person and take that as a charge against the business. That is the most common method for valuing trademarks to put them into those balance sheets that I mentioned at the beginning. And it's perfectly reasonable as a technical valuation method. But let me say, for marketers, the most important thing is the value of the branded business. The most important thing is the margin or earnings uplift effect across the whole business. And that's what you need to focus on when you're doing strategic brand valuations. Look at the branded business, what effect uplift is it having? Whereas for technical valuations, it's very much, just give me a snapshot at a point in time, I'll put it in my balance sheet. Now, our league tables that were published the other day is a royalty relief valuation. It's perfectly acceptable for financial reporting purposes, and in fact, that's why we did it that way. But the most interesting studies that we do are the ones that look at the branded business as a whole and try and work out how can we increase that by pulling all of the strings and manipulating all of the levers. They also say that you have to put down a number of things. So this is consistent with that requirement for transparency that Bob Eccles put forward. The position and status of the appraiser, why you're doing it, identify the subject brand very clearly, what are the brand-related assets you're valuing, who are you addressing it to, what is the premise of value, in other words, going concern or not, what approach and methodologies have you used, the date of the valuation, and the valuation, the value date. The value date might be the 31st of December. The valuation date might be the 31st of March. So I valued it on the 31st of March, but with effect as at the 31st of December. Where did my data come from? What are my key assumptions? What limitations? All of that needs to be exposed, and it's consistent with that view that we should have transparency. And finally, it demands, more or less, that it should be done independently to avoid conflicts of interest that might affect the result. So our approach, just coming back to that chart here, as I said, we look at the three different levels. We tend to focus on the middle level. The middle level is the area where you have most impact in saying how value can be increased and grown. We also value the trademarks in the middle, but we focus on saying how do we increase the value of the branded business. And as a process, first of all, we do a brand audit to make sure we understand everything, the business and so on. Then we do what we call value mapping. Value mapping is that point I made a moment ago about understanding how the business works. So, for example, here are a few clients we've worked on in the last year or so. Right. A cognac business, its business model is entirely different from a hotel and leisure business. With cognac, you make the stuff, you stick it in barrels, and you can't sell it for 10 years. It evaporates. You distribute it via different means. Hotel and leisure, you build a hotel, and if you don't fill it, you don't have occupancy, you don't make money. So the nature and structure of the businesses are completely different. And actually, there's one in here which is quite interesting. The loyalty voucher card business. This was a company where you pay them money, they put it on a card, and you give it as a gift to somebody. Normally, they charge you 5% for putting it on the gift card. They charge the retailer 5% for redeeming it, and they hold your money until you redeem it. So they have about 3 or 4 different revenue streams. They have to be quite careful in the way they do their marketing, because if they do too much marketing, people redeem them quicker. And if they redeem them quicker, the fourth revenue stream is if people don't redeem them, they keep the money. They expire after 9 months. So they have this dilemma in their marketing department. How much do we promote usage of those loyalty cards? Because if we promote it and spend lots of marketing money, what happens is we get the money spent quicker and we don't get the write-offs. So when they look at that, they might say, let's not market at all. We'll make more money out of it. So they have this equation. Is promoting the use of the card better for getting future sales, or is there a limit to the amount of sales anyway? So you have that whole debate about what's best for the way that their marketing business should work. And if the marketing people do not understand the financial mechanism of the way the firm works, they will never understand really what they should do. And this is in the oil business, retail fuel, you're working through a retail network of shops on the side of the road. You have to have a retail team and a product portfolio, and you've got business and domestic customers, but you go through that network. Another business in the same company, which is liquid petroleum gas or lubricants, it's totally intermediated. Nothing goes direct to customers. It goes through distributors. So half your marketing is to distributors. So any marketing you do is a pull-through through the distributors. So the business model is entirely different. In order to understand how the brand adds value, you have to know how that works and know where you should be putting your emphasis. Should you be putting it on the distributors or the end consumers, or what's the balance? And many industries are like that. So you have to understand that. Then you have to go through that whole brand equity thing I mentioned to understand what drives demand. And only then do you sit down and do your valuation and draw conclusions. Now, I'm going to give you an example of a brand in the UK called Hovis. Hovis is one of the oldest and best-known brands in the UK. Now, this is very much a UK example, but I think actually it has a lot of echoes for here in Turkey. This was a traditional, high-quality brown bread that originally was sold like that, out of wrapping. And the Hovis brand was stamped on the side via the tin. And they used to sell it in bread shops. Gradually, they began selling it in supermarkets, and they put it in a plastic wrapping. But frankly, the wrapping was boring. You know, it was kind of like white wrapping with no particular features. And they only made the brown bread. And initially, they didn't even slice it. So while they were famous, well-known, and actually, the other thing that one should know is this was the first brand that was ever valued by Interbrand as part of a defense takeover because their share price was too low. And we were trying to actually push up the share price to avoid being taken over. An Australian company called GFW was trying to take them over. So they managed, the brand valuation helped to fend off the acquisition. They then carried on trading, but they were becoming increasingly irrelevant to the consuming public. So that's where this story starts. So for example, if you look at their share, their volume share was entirely geared to their relative price under everyday low pricing. The supermarkets were driving down the price, and then the volume went up. Not very helpful, because then what happened was, because their prices were going down, their margins were going down, they had to cut their advertising. As a result of which, their key competitor, called Kingsmill, another bread brand, were spending money, and it was going up. Kingsmill had a different portfolio, a wider portfolio, so they were spending more. As a result of that, their ad revenues were going down and their brand awareness was going down. So they sat down and they looked at all the research, and they had a lot of research. What was it? What are the drivers of acquisition? Why were people buying Kingsmill, not Hovis? And they started off by looking at their heritage. What do they stand for? It's all about wheat, germ, flour, bread. They looked at their field of competence. It wasn't just brown bread. They were good at all bakery products. They then looked at their point of difference. Hovis is good for you. It's a bit like that example that John gave before the break. You know, it's not just about making matches. You can do anything to do with the fire category. And Hovis could do anything in baked products that was good for you. So they looked at their target audience and realized that the old product was largely appealing to old people. So they wanted to make it relevant to the mothers that actually buy it and give it to their children. So then they looked at the personality and sort of talked about that for a while, and then they worked out the mission to provide everyday goodness for everyone. Right, so it was all about everyday goodness, not about brown bread anymore. So the first thing they did was completely jazz up their packaging and used econometric modeling to demonstrate that the packaging drove significant sales in supermarkets, which they then went to the trade and said, look, we're getting higher sales pull-through because we got this great packaging. They also produced brand new ads that weren't traditional but were now appealing to kids. They also diversified. I think actually this was a product that originally came from Australia, and Hovis just said, well, that's a good product. It's a mixture of brown and white bread. So mothers can feel happy that they can say it's healthy because it's brown, but kids like it because it's white and it's soft, really. And once again, they were able to trade people out of own label white bread into this best of both stuff at a substantial price premium. You can see there, it went from trading up from 29p loaves to 59p loaves. So product innovation, packaging, advertising, all changing the attributes that described the Hovis brand. Now, the actual sales when this campaign started were substantially higher than the previously predicted sales. And as a result of that, the contribution margin to the business was substantially higher. And this chart shows what happened to their market share. Their market share went from being second, just over 15%, to something like 21% over the period of the campaign to rebrand and relaunch them, but it continued. And a couple of years later, their market share had got to 30%. Now, coming back to brand valuation, all of that analysis was done by the marketing department, but in close cooperation with the finance department. Like a lot of companies I know where they have a smart finance director, the smart finance director was doing the analysis in order to fuel his valuation model. And if you look at a discounted cash flow valuation model, okay, this is a simplification of a brand valuation model, you can see here that your historical performance contributes 0 to the value at today's date. It tells you what the value might be. So whatever you did historically just is telling you what you might do in the future. The real thing is, what will you do in the future? What do people believe you will do in the future? The next 2 years probably account for about 20% of value in most valuations, and usually they're relatively predictable from operational measures. The next 3 to 5 years maybe represent another 20 or 30%. The real value comes in the end, more than 5 years out. And you could say, well, that's rubbish. How do you know what's going to happen 5 years out? The reality is, where it comes to asset valuation and share valuation, it's what people believe will happen 5 years out that matters. So the short-term measures drive their long-term strategic view about the overall valuation of the business model. And you can use desk research and econometrics and predictive research that will help you to determine what that projection looks like. That is a strategic valuation. Now, you might say, well, how much use is that? It's very useful where it comes to the point that I started with, which is about share prices. This company, Hovis, was owned by a private equity company called Doughty Hanson. They wanted an exit, and they wanted a successful exit. As a result of doing all this work, they increased the bread category. They increased they've got a very healthy return on their advertising spend. Their sales leapt because their market share went up, and the profits leapt accordingly. They then decided to make their exit, and it was a very successful exit. Now, it might not surprise you to hear that the person that was driving the whole marketing agenda and who was almost telling the marketing department to spend more was the finance director. He was telling them to do it because he was preparing the company for a successful float. Now, fine, that's a one-off transaction, but many other companies want to do the same thing in order to convince their investors that they've got a valuable property on their hands, that they've got a valuable branded business. So sometimes people say there is a conflict between finance directors and marketing directors. I don't think there is, as long as they speak the same language, which is about value creation. And usually that means value creation for investors. So finally, you can do a brand scorecard and just measure it from time to time, where you show the segments and you show what the values are and you show what you're spending and so on. And then you can make decisions about whether you should move that around. I won't bore you with all that at the moment, but that is a good idea in order to optimize value. In fact, we did something like this for a food company here in Turkey last year, for Pınar, looking at their portfolio to say where and which brands should they really be allocating more resources to build the business. So in conclusion, here's the old saying, what gets measured gets done. There are a number of measures you can look at, from promotional payback, short-term customer profitability, simple correlation and regression, through multiple regression, predictive research, and at the top of the pyramid, or the top of the list, is that kind of strategic brand valuation and branded business valuation I've described. I think it is a very helpful tool in conjunction with these other short-term tools to help drive the strategy of businesses. I would strongly recommend it to you. And just to conclude, make sure you communicate with that CFO. This is a piece of research that shows most CEOs speak to their finance director more or less every day and trust them more than anybody else. So if you convince the CFO that the marketing agenda and the marketing budget will add value to the business, he will be your ally, not your enemy. And the very last slide is, at a time of recession, this was done in a recession at the back end of the 90s. And in fact, this comes from a firm called Profit Improvement of Marketing Strategies, which is based in London. They measure things that, marketing actions that might have improved profits. And they took 750 companies, roughly, and said, in a recession that had just happened, who cut, who maintained, and who increased during that recession. And what they demonstrated was that those who cut, the share of market change 2 years into the recovery after the recession ended, obviously the cutters had much lower growth in their share of market than those who increased during the recession. So what this is arguing is advertise harder and more during a recession because everybody else is cutting back. That's your chance to build your brand equity. So when you come out of the recession, you grow. And they then looked to see what was the return on capital employed, and they found that the higher return was for those that increased. Now, I suspect probably the advertising industry was behind all this. They were trying to persuade everyone to keep advertising. And the final chart there shows that they demonstrated a higher return from pure advertising than mixed or promotional spend. Now, this is a slightly old study, and I think probably nowadays that would be flipped. You would probably get more from promotional and internet spend than you would from advertising. But my hunch is the same argument would be true. When budgets are down and people are cutting, it's best to spend into that if you have a good proposition. And I would suggest that that is a lesson that brands in Turkey might take as they go abroad if they can get their proposition right and advertise heavily into the recessions or market heavily into the recessions in places like the UK, they'll come out the other end with strong and valuable brands. Thank you.